Hi everyone, welcome or welcome back to another episode of The Lens with Craig Shapiro and Larry McDonald. This week we have such great guests. We have our friends at SeaWolf Capital. We have Porter and we have Benny. We're so excited to hear everything that they have to share with us and with you. Remember, we run an institutional live chat on Bloomberg with more than 600 investors all around the world. We have more than 150 contributors. Also, we have our Discord channel, our turning point. We have everything tailored just for you. If you're interested, do not hesitate to reach out to info@thebirdtrapsreport.com. Craig, Larry, guys, go ahead.
Thank you, Valentina, and thank you the team in New York. Great setup. Vinny and Porter, good to see you guys.
Good seeing you
Um,
guys.
it feels like Groundhog Day. We've had like in the last couple of years, I guess we've had three or four recession scares, and now we've got Atlanta Fed GDP bouncing again. How are you playing this? How are you playing the tacos with Trump? What are you looking at this week? Like, what stands out this week for you guys?
Well, we usually try to keep it simple, right? And we had this saying a long time ago, going back more than a decade now. But if macro is your theme, investors will redeem. So, we like to keep it simple. And I think that the simplest trade that we see is, Trump pivoted obviously from the taco stuff going on, and
Now describe what taco means. A journalist came at him and said Trump can't handle the pain.
yeah,
Trump always chickens out.
Trump always chickens out. Okay.
So whatever that he does is art of the deal, but his administration first started off, gold and other stuff like that sold off because they had this view that Doge was going to come in and we'd have some fiscal austerity and we'd have this 333 arrows plan and everything would be this kumbaya. And, we're pretty cynical about that. And if you look back to Trump 1.0, Trump was a money printer. He ran a big deficit. And when he got into trouble with I think that the tariff thing was poorly executed, too much hammer, not enough finesse or whatever it was. And he had to backtrack. And then they went full pedal to the metal with this big, beautiful bill. And austerity was out the window. Elon, they're having a press conference today. Elon's gone.
So if you're a global allocator or bond investor and you're watching the United States, and a month and a half ago they were promising you austerity and balanced budgets, and now we're back to essentially a Biden type budget. I mean, what is the global bond investor doing right now?
If I was a global bond investor, and I actually think what the markets told us, so let's rewind the clock about 3-4 weeks ago, right before the pivot, Liberation Day, as Porter was saying, and the like. One of the most interesting things that happened was that rates did the exact opposite of what Trump and Besant believed they were going to do, right? Like the whole goal in the game plan was, I think, to get long-term rates down to 3.5%, which would force the Fed to cut rates 150 to 200 basis points, which would create a sort of mini refi boomlet or housing thing that would help the economy as we get along, flowing through the tariffs and the redirecting the order of global trade. That didn't happen, and it wasn't happening. And it was, if you remember, despite where the markets are, it was quite frightening, and a lot of people were scared. I think the markets essentially gave an extremely cynical view, which is, hey, given our debt levels, any attempts of austerity are not going to work. And because we're too levered, the capital markets are too levered, the unwind hurts. And so we stuck the proverbial needle back in the arm, right? And to us, that means the market is telling you there's only one way potentially out of this, right? And that's continued monetary debasement.
Right.
That's the punchline. And as a result, while gold has had a great run, and understandably so where it is on certain technical levels in terms of its near-term overbought and the like, We just continue to believe that the only way we get out of this is continue to debase our currency. And so that has been one of our largest themes and continues to be our largest themes. And we don't, aside from slightly overbought conditions, and we recognize it and see that, we don't see any other reason to change it. So that would be my message to bondholders. I would be a little scared to be taking long duration risk, even if you see a trade where we can go down 30, 40 basis points, which I know is powerful. It's not something we want to do right now.
Now, Porter and Craig, one thing I'm noticing is that, and this is something I'm hearing from clients. So what we try to do is in the chat, and Craig's running our Discord room. It's phenomenal. Join us in there. If you're not on Bloomberg, if you are on Bloomberg, join us in the chat. But what I'm hearing, guys, is that, think of like the last 2-3 years. By now, Goldman, the street told us that Fed funds would be a lot lower. And so we are turning out to be higher for longer. And every day that we're up here, the bottom 60% of consumers, there's a lot of different players like triple C's here, junk of the junk, companies that are stressed. So equities have bounced all the way back up to the highs. We're higher for longer with yields. And you notice here, Porter, what do you think here? But why are triple C's not back on the tights if equities are back on the highs? Is there something going on here?
That's probably a bit above my pay grade, and I don't try to think about that too much. But there's been this narrative of we can have higher yields and higher stock prices. That's the sort of the millennial cool pitch these days, and I think it's horrible. And I'm more old school, but I think that the market might be going up as a function of tech and all these non-levered companies, which they're great. Microsoft beat the quarter, making new highs again. But I think that when you see lower bond yields, you see a broadening out of the base of stocks doing well. You see more real economy stocks doing well, housing, consumer and stuff like that. And so, that's what makes me bullish. If they can, I guess the PPI print was today, I believe, and it's showing a lower inflation number. And, if you can get that, and if you can get Powell to cut and the 10-year down, which Trump obviously wants, whether it's, you see the end of QT or for whatever reason, that's what would make me more bullish on a broadening out of the economy. And you don't have to buy 7 stocks, right? Or Palantir and whatever that cohort of group is, the no debt, who cares about bond yields, just buy liquidity flows. So that's how I see it. And what's going to take to get me more bullish is lower rates. And you've seen that over the past couple of days, whether it's because what Vinny was talking about, or maybe inflation coming down or whatever. But I don't buy into higher rates is good for, the economy can be fine with higher rates. I think it needs lower rates. I think the government needs lower rates. I think the consumer needs lower rates. I think that there's a ton of refi in the CMBS market, in the high yield market, and so I think we need lower rates.
Craig, you can see it here in subprime. A lot of these, like buy now, pay later, and credit acceptance is not one of those companies, but the buy now, pay later, credit acceptance, the companies that face kind of the bottom 50, 60% of consumers, they're showing some stress. Capital One's just fine because the merger. Craig, what stands out this week for you, Craig?
Yeah, look, I think you have this very bifurcated economy where, the higher end, higher income, higher savings, asset rich part of the economy is doing incredibly well. And the lower part of the K-shaped economy continues to struggle. And more people are finding themselves in that lower rung every day. And as long as rates stay elevated, I think you're going to see that dichotomy exist. And so you had earlier in this year and into the tariff announcements, the soft data really plummeted lower, and the hard data really has held up better than expected. I think what we're getting now is the hard data starting to roll over moderately, and that may continue. We'll have to keep an eye on that. But the soft data has bounced because of the tariff reprieve, and so sentiment has bounced. And so I think the question is, where do those two lines meet? Will hard data continue to fall and the soft data bounce stall out, or will hard data be fine, hold up, and then reaccelerate? And I think in this elevated yields environment, I think it's going to be tough for the hard data to really reaccelerate, and at least short term. And then we kind of have to factor in, where do we ultimately end up on this budget, right? I mean, the big beautiful bill that the House has passed really doesn't seem like it's going to fly in the Senate. Some hardliners, Senator Johnson, Senator Paul, Senator Rick Scott, and various others are really talking about a bigger chunk of spending cuts necessary in order to pass this bill. So that's more anti-growth. So where is the impulse? Where is the fiscal impulse here in the next 2 to 4 months to really reaccelerate growth? So that's what I think, that credit spreads not returning to the tights, triple C's. There's this dichotomy between big banks and smaller banks, and this high yield OIS spread here as well. I think is showing some of that strain and some of that that to be determined dynamic. And if the data continues to roll over, I think risk assets broadly struggle over the course of the next few weeks while we digest that uncertainty.
Yeah, thanks, Craig. Vinny, is it me, or I've had in the last month, maybe last month and a half, I've had maybe 15 different clients that don't really know each other, in different parts of the world, start talking about how much this period reminds them of 2007. They're not saying we're heading into 2008, but what's going on? Why are people are comparing this time? Is it because of the student loan issue? Credit, all these millions of I guess credit scores were kind of not really true because you're going from a progressive administration in the Biden team over to a conservative, and now all of a sudden credit scores are going to kind of come back to reality for millions of Americans. What do you see that reminds you, or do you agree with that kind of reasoning that I brought up?
I actually don't agree with it, and the reason being is because the issues we always go back to, where's the excesses, where's the leverage, right?
Yeah.
And I don't feel this time that the leverage resides in consumer finance. And I don't feel like the leverage resides in the banking system that is financing consumer finance. Let's rewind the clock. Back then, you had multiple of derivatives of credit, CDOs, CDO squared, and the like, on a banking system that had capital ratios, and the way I'm calculating it, just total capital to assets, tangible capital to assets, that was less than 3%. We don't have that right now. To us, the issue resides in who's levered, the sovereigns, right? Who's continuing to lever, the sovereigns. What else?
So that's governments, right?
Governments. And then what else is levered? The entire capital market system is geared that the incremental dollar of capital, whether it's in equities or fixed income, is done on a significantly levered basis, whether it's 3-time ETFs, 2-time ETFs, or the vol targeting funds, or basis trades on buying incremental treasuries. To us, that's what we worry about, which is a scarier concern than I think, to a certain extent, than the GFC was. However,
different concern.
Different concern. However, unlike the GFC, the powers that be, the Fed and the government, know this. So that every time it gets a little bit out of whack and the volatility indices, like the move index, go a certain thing, all of a sudden, as we like to call it, the roadrunner does his meet and everything is fixed, mainly because behind the scenes, the Fed is doing something to improve liquidity, to reduce volatility, to keep the machine going. That's the way we see the risks. It doesn't remind me of GFC. We think papering over the GFC caused what we have right now, which is we took all the risk and put it on the sovereigns and capital markets.
Yeah, and I think, Craig, that the last week and a half, you had Japan yields blowing out on the long end. You had U.S. yields blowing out on the 30-year. So you think about duration, guys, and this gets back to kind of Vinny, your point. Think about the psychology of a long-term bond investor. The last 20 years, you made money year out. And now, since 2022, if you own 30-year bonds or even 20-year bonds, you really haven't made any money for 2 years, right? And so, and then you have this big $1 trillion deficit in the first quarter of this year, just in one quarter, on nearly $1 trillion. And then you have Trump going from fiscal conservatism back to blowing out the deficit, not much austerity at all. So, Craig, like if you're a long-term bond investor and you haven't made any money for 2 years, do you think there's something going on there where those types of investors are kind of like moving away from duration toward the middle part of the curve, and that's why the global bond yields seem to be drifting higher? In kind of a, if the economy stabilizes, it's almost like we're gonna be up near 36% on 30s.
Yeah. Look, there's always a segment of the institutional capital world that's going to have to invest out in the long end. But I think from more discretionary, investors, it seems like they are certainly moving in. I think more importantly, foreign investors who have historically found themselves owning long duration U.S. Treasuries, either hedged or unhedged, are increasingly finding reasons to remove that capital from the U.S. Right, and so whether it's domestic stories of defense spending in Germany or infrastructure spending in Europe or consumption spending in China, right? The narrative around investing at home and away from this U.S. exceptionalism story, I think is out there and I think is growing. And so I think that also is leading to some pressure on the long end, as more and more governments are going to have to fiscally spend and deficits are going to blow out globally. But for sure, I think, Trump administration came in with a plan about reducing the deficit, and it seems like a hard pivot is upon us. And Bessent is now talking about just outgrowing the deficit, outgrowing the debt growth, and running it hot. So I think that shift in narrative. And finally, just on Elon and Doge, I mean, here you have the smartest guy in the world, the richest guy in the world, sitting at the right hand of the president with unlimited access to cut spending and eliminate waste and fraud and abuse. And 4 months later, he quit. Right? He said he couldn't get the job done. So I think that's discouraging. Whether or not you believe how big the savings were going to be ultimately or not, he really couldn't get it done. And that's how tough it is to reduce spending. And so if he's unable to do it, not clear how we're really going to be able to move the needle on that deficit spending reduction. I think the bond market has noticed that.
Hey, guys, can you hear me now?
Yeah.
Porter, one thing guys are talking about in the chat this week, so we run that institutional chat on Bloomberg. Please join us. June is the best month of the year for oil. And we have an Atlanta Fed data this week in terms of GDP up a lot. So we've gone from the probability of recession's gone from 68%, according to Polymarket in April, 68% back down to 30. So maybe 30, 36. So there's potentially a bounce in the economy. But look at this. If we get any kind of bounce in the economy into the summer driving season, and you can see here with CPI, look at gas prices. I mean, you're going to have higher gas prices, most likely a bounce in CPI, higher oil. I'm warming up to oil here because the bull case that I'm hearing from clients is if we go lower, the shale region stops producing, right? And also the Saudis can say whatever they want about wanting lower prices, but financially, whether it be Aramco or whether it be the princes or the budget, I really don't think the Saudis want oil that much lower. And then if you think of the Trump team, they want oil prices lower in November of 2026, not 2025. Are you warming up to oil here in the oil names, Porter?
So, the way we think about stocks generally, and we're contrarians at heart, right? And so you got to look around the market and say, what's the most hated sector of the market, right? Trump's pissing on oil every day. The Saudis, talking about less cuts, and you could argue that oil is still pricing in the tariff recession, right? The oil prices have not bounced at all since Liberation Day. And so, to us, if you're right and CPI comes down, the Fed's able to cut, which obviously the Trump wants. We saw Powell yesterday. A lot of these energy stocks aren't pricing in anything. And so, if that's right, people go from very underweight to either moderately less underweight or to neutral, right? And usually those are the best trades, from really effing bad to not so bad. And so, if you're a simple risk reward investor, do you buy Tesla at 250 times, 300 times PE just because it's going up and that's where the liquidities are flowing? Or do you make more money being a contrarian and say, okay, if I'm wrong on oil and oil goes nowhere, I'm going to earn the dividend in some of these stocks, which is a lot of times 5%. If I'm right, I can potentially, make 20 to 60% over the back half of the year. So that's how we think about it. Thankfully, I don't have to judge against the S&P and all that kind of stuff. So it's a bit different. And I realize energy's 1% of the S&P right now, or whatever it is. So, I think if you're not an index chaser, I think, finding these corners of the market where the risk reward is really on your side, and you can say, I can put a lot of capital into this, is saying my downside is really low, right? If you're buying Tesla up here or Palantir, I think your downside is fairly high.
Right.
So that's how we think about things.
Craig, how are you looking at oil this week? Are you, June's the best month of the year. Seasonality's coming back. I'm noticing the rigs of the world, the Schlumbergers, bottoming. I'm just hearing from a number of clients that are turning more bullish on the space. Or any thoughts there?
Yeah, I mean, the only thing that I think we got to keep in mind is just what is OPEC? What is OPEC going to do? There's this meeting and discussion about them increasing production higher than what they originally thought. So I think that's increasingly being priced in. But look, I think it gets back to how robust is demand in the U.S. Been monitoring the TSA checkpoints and out of for airlines demand, and they're now running down 1.5% year over year on a trailing 28-day basis. So that's kind of your best real-time indicator of travel demand. Starting to show some signs of slowness. So, look, I think the medium-term story with rigs getting laid down make a lot of sense, and kind of oil, working in 26. I just think right now it's, to Porter's point, it's just kind of unloved, right? It's just there's nothing that I think is getting people, too excited, which I think is a good thing from a medium-term perspective. But finding that catalyst on a shorter-term perspective to get capital flowing into the space, I think. I don't sense from our chats that people are moving in that direction yet, but that's something that obviously we're watching for.
And Vinny, I find it interesting that with the last 15 days, with the 30-year kind of week, the Japan and the U.S. long durations week, and all of a sudden you can see this move in Bitcoin, platinum getting some love, silver on the verge of a breakout. If you had to pick a metal here next year, platinum, silver, gold, copper, any favorite spots there?
Well, I have a running joke. If everyone has, for the people who have an American Express card in their wallet, that the hottest card, or aside from the black card, if you're a real big spender, but like the hottest card or the most expensive card is the platinum card. It's not the gold card. And yet, if you look at the price of gold versus platinum, platinum is significantly cheaper than gold on a price basis. We actually have been buying a little bit of platinum, not that it's our forte, but just simply a function of, again, as Porter said, we're contrarians, but also there's a bit of a fundamental backdrop behind it as well, we believe, in that it seems as if hybrids are going to have a place in the incremental cars that are purchased on a global basis. And that means catalytic converters are needed, and therefore platinum and palladium are needed as well. So I would choose platinum. We've already had a comment on gold. In terms of silver, we are bullish, although I don't think it acts or correlates with gold as much as people think it does anymore. That's just my personal, but that's just a personal opinion. And for copper to work, I think you need China to work. That, at least initially, like China stimulus and copper seem to be synonymous. So if I had to choose one of those, aside from gold, would be platinum.
And platinum. I'm sorry. Go ahead, Porter.
No, I was going to say, before we end here, I think it'd be useful to get Vinny's opinion on the GSCs. You know, Vinny was the lead analyst on Fannie and Freddie back in the day, so you can talk to him about that.
So
that it's been an incredible ride. I mean, we know so many different funds that have been in and out of the trade. We've been at the Bear Traps Report. We've been in the trade off and on, and I'm proud of the way we've done it because it's been a great trading vehicle, Vinny.
yeah.
God bless the Tim Pagliaros of the world that have really, maintained a position. He's amazing. But they're having their day in the sun now. I find it interesting though, Vinny. So Trump's much more vocal now than he was in the last administration in support. But we still haven't seen the executive order, and we sold off a little bit on the news. I thought we'd rally a little bit more in the GSCs, Fannie and Freddie preferreds.
I would have thought we would have rallied a little bit more too. But to answer the question of why do I think he's being more vocal, and I think there's two reasons. One is we are in an era of fiscal dominance, right? And even though it would be a one-time windfall to the government in terms of converting some of the sovereign wealth fund into cash, Fannie and Freddie would provide him a much needed win in terms of converting some of the assets into cash over time.
Okay, so let's walk that through, Vinny, for the broad audience. So Robert Van Battenberg, our one of our top strategists, Craig and Robert, he says in the fourth quarter of this year,
Yes.
fourth quarter, the issuance of selling bonds, we're going to be up at 575 billion more than last year because the debt ceiling, they haven't been able to sell bonds right now in terms of net new issuance. They sell bonds, but for every one that's redeemed, one is issued. And then there's a huge catch up. And so if you think of like from September 1st through June of next year, the amount of bonds that have to be sold, and what you're saying is if they can monetize this position, that eases that problem. Is that what you're trying to say?
Yeah, it helps that. It also helps from a fiscal perspective. It just eases what is obviously going to be a never-ending need of liquidity or funds to fund our treasury, right? So I think that's one of the reasons why he's more vocal. The second reason, which I don't necessarily know if this is coming from President Trump, but it's just a fact, these things right now, so rewind the clock, during Trump 1 administration, these companies were severely undercapitalized, right? They didn't have enough capital to come out of conservatorship. They weren't even close. Fast forward to today, we're still undercapitalized, but we're getting there and we're getting closer. How they do it still remains a mystery. We'll find out in terms of what they do with the different equity pieces, the senior preferreds, the equity and the warrants. But these things are in a significantly better position to the point where they can come out of conservatorship. So I think the combination of the two is the reason why I think President Trump has been more vocal.
And if you think of the SLR, think about the last 2 weeks. We got the long end blowing out in 30s. All of a sudden, the government's monetizing assets, which is like, oh my God, it's a very different thing. And then the SLR, which is essentially a move toward financial repression, where you're not forcing the banks, but you're really leaning on the banks to buy more treasuries over the next year. This is the bag of tricks. Isn't this a walk toward financial repression where they try to push interest rates below the rate of inflation and monetize the debt?
Are you pitching our gold position right now, Larry?
You'll get no argument from us. Yes. The answer is yes.
I'm just leading the witness.
All right.
We joke around whenever we're in meetings. I always like to do it's always nerve-wracking when someone does it, but do a show of hands, right? And I go, who is buying long duration treasuries on an unlevered basis right now? And more often than not, no hand goes up, right? And we say,
well,
okay.
Vinny, how about this one? During the GFC, Warren Buffett invested heavily into the long end, right?
Correct.
Now he's 100% in bills.
T-bills.
That's a great point.
And I always say, so you guys are all bullish on markets, yet the one thing that is needed to be done to keep this bull train going, which is buy bonds, you won't do, right? Someone's got to buy them. So I think they're trying to solve the someone's got to buy them. You know, I can imagine part of the negotiations with trade, whether it's in Saudi Arabia and the like, that the question of, hey, buy our bonds comes up. But in addition to that, the best buyer of bonds is a well-compensated, levered entity, right? That if it goes wrong can be bailed out by the taxpayer. And nothing suits that better than the U.S. banking system.
Wow. Well, I promise. Thank you, Vinny. I promise you guys. I think you guys have a lunch to go to or a meeting. Thank you so much. Craig and I will wrap it up. I look forward to getting together with you, Vinny, next
Yes.
week in New York. And thanks for being there. We're going to host an ideas dinner in New York next week. We've got a book signing at the Harvard Club. We've got some events at the Lambs Club for media. Our book, How to Listen When Markets Speak, #1. Oh, it's in the top 10 this week, not number one.
Picture of you, by the way.
I know.
Oh yeah, I mean, you know, I've got a 10-year-old and an 11-year-old. I need to stay young. So thank you. But Craig, thanks for everything this week. Any closing thoughts on what you're seeing from the
No,
clients?
another quiet month, 2 quiet months in a row right here. We're finishing close to the highs. I mean, Trump speaks in a little bit. We'll see if the China tariffs, which are annoying him again. We'll see if he comments on that. And next week is a big data week. Powell speaks on Monday. We get the payroll report, and so we'll get a lot of data about whether or not hard economic momentum in the month of May decelerated aggressively or not so much, and that'll set the stage for I think the trade into the middle of June and through the rest of the second quarter. But no, it's been another good week. I appreciate all the insights and enjoy your time in New York, Larry, next week.
Okay, thanks, Craig. Thanks, Vinny.
Craig, thank you, Vinny. Thank you, Larry. Thank you, Porter. This was great insights. As Larry said, we'll be in New York next week. We'll be hosting events at the Harvard Club, at the Lambs Club, at the University Club. We're going to be hosting ideas dinner, cocktails, book signing. If you're interested in joining us at any event, also reach out to info@thebirdshopsreport.com. Remember, guys, we have an institutional live chat on Bloomberg. We have a Discord live chat as well. All of the reports mentioned throughout this video, we're happy to share them with you. Again, reach out to info@thebirdshopsreport.com. Remember to get your book. We're in the top 10 this week, as Larry said. When Markets Speak, now available in Portuguese, Chinese, and Korean. Thank you so much, guys, and we'll see you next week. Bye.